Or no?
Yeah.
Go ahead. I'm
I
recording.
do. What's up, guys? Welcome back. Another episode of the Average Money Podcast live on YouTube. It is a Wednesday night. Having a couple beers tonight. JJ's got his hazy IPA. I've got the number one selling beer in the world, Bud Light. Not sponsored by Bud Light, but hey, give me a call or give JJ a call. Budweiser Brewery is right down the street from your house. If this is your first time listening to the podcast, welcome. We're going to talk some options tonight. Very simple, not numbers. If you don't know options, you never heard of them, we're going to give a pretty good introduction, at least get you thinking about it. If you hate options, you shouldn't. I'm a boring index fund investor, and I love to do them just for the love of the game, the sport, the fun, the community that's trading options. It's not all meme stocks. I'm joined this week back in Missouri, sweating his butt off in his upstairs attic. Fresh to death, New York sunburn. How we doing, bud?
I need another cannoli.
Cannolis.
Dude, man, I will tell you what. That's when I came up there. Well, first of all,
I totally forgot why you wanted cannoli. You brought it up, and I'm like, where did he read that? Yeah, we have good cannolis, but like, what made you think of that? And then you told the story.
Yeah. So last time I was there, we had a bonfire, and one of your neighbors, isn't the girl from Staten Island or something, or she has like a true Italian family or whatever. They all came out, and I'm not lying to you guys. Each family member, all 8 of them or 10 of them, however many walked out of the house, had something different in their hands coming out to the bonfire. And here's JJ. I love food. Trust me, I love food. Even if I'm stuffed and you bring me food, I'm going to try it. They're like, oh, try this. And they keep, giving you food or whatever. And then they got the cannolis. I got to the cannolis, and I'm like, the heavens arrive.
I'm not a cannoli guy. I couldn't care less about cannolis.
You're not a sweet guy, dude. I don't get it.
No, I like salty and crunchy. I have people in the chat. Are you salty, crunchy, or are you sweet tooth? I have no sweet tooth.
I got
cookies,
the sweet tooth.
ice cream do absolutely nothing for me.
Oh, I'm not gonna say that.
I have. The last time I had ice cream was just to like be like socially like accepted.
Dude.
Like I was somewhere where like maybe it was like ice cream cake.
The cannolis for me are a game changer. And as we know, when I bought the couple cannolis to bring back to the house, and then I ended up buying I bought this like cookie sandwich cannoli, whatever it was like 6 pounds. I ate the whole thing that night. I'm not gonna lie, I did it, and it was amazing. It was so good, so good.
No, because we found like the actual cannolis, and then you were like, Brad, look at this one. We had a couple cocktails. Look at this one.
I had to get it. I had to,
and
man.
I was like, dude, that's a family cannoli. It was the size of like a small like dinner plate.
And I'm like, I'll eat for a family of 4 tonight. I don't care.
You did. Because I think you assumed I was gonna have one. And like,
yeah.
Nah, I didn't. Nah.
Oh, okay, Brad. I guess I'll eat it. Don't worry about it. I got it.
sat on the couch. I just watched in awe as you just nibbled. Because guys, when you find out some things about people when you're hanging out with them, JJ eats like a bird. So like he nibbles. He takes very small bites.
I enjoy it.
Very, very small bites. He's like the 2 times we ate, you're like, bro, you like looked over, my food was gone.
No,
like,
I'm serious. We literally we get our food handed to us. I look over to Brad, gone. Food's gone. I'm like, dude, what do you do? Like, cause I see him like sitting there, just like chatting up to whoever's sitting next to us or whatever. And I look over at his plate. I'm like, I got like a quarter of my food gone. I'm like, oh, this is pretty good. This tastes. I look over. I'm like, Brad's not eating anymore. And I look at his plate, gone. I'm like, dude, did you enjoy it? Like, you're like my dog. I give him a treat and it's gone in 2 seconds.
It was like a big cookie thing, and you kept spinning it. And just...
Hey, well, I'll say this real quick, man, because this probably won't go out for a while. So shout out to everyone who's watching live. This episode probably won't go live for another 4 weeks, maybe.
Ish.
I miss being in person, dude.
Unless it's a bang episode. Unless things just get.
If they're
I
solid,
will push it right to the front of the line. If this is. Oh, Mr. Shadow wants to know if you had New York pizza.
Oh, I did. I don't know what it was, but we had or where it was from, but we had the buffalo chicken pizza. Oh. I literally picked up 1 piece, and it was about 25 pounds. I didn't know what to do with myself.
He's like, it's just a chicken, and I'm like, dude, it's buffalo wings on a pizza with the perfect amount of blue cheese to spiciness ratio.
I was literally telling Lindsay today while we were eating out tonight. I said I already miss New York. The amount of things that you guys can do in a 20-mile radius or a 20-minute radius from your house is it blows my mind. I mean, you've been to my house. We have a McDonald's, a Subway, and a little local bar.
The Dewdrop.
Everything else is a 20-plus minute drive to just go to another restaurant. You
said you drive 30 minutes to get your haircut.
Yes. Dude, I'm just like, am I living in the right spot here or what? But we also did calculate our taxes. Your 1 year of annual taxes pays for 16 years for me to live.
Correct.
So that's where you're like, I'll come visit New York.
That was crazy how the tax bill came the day you showed up. I'm like, I'll go read that. That's in our previous episode. When
it was. Yeah.
So we don't have to beat that. But let's talk options. It's funny because full disclosure to everyone listening in the chat, and if this makes it out, everyone that's listening at home, we've tried to do 4 options podcast episodes.
Yes.
And we always get about 10 minutes in and we're like, fail.
Doesn't work. And it is usually because of me.
No. It's because it's hard without numbers.
It is. And
I think what we always tried to do, and we learn something every time.
Yeah.
And I think we've gotten to the point where like we just have to keep it super simple, not even numbers.
Yep.
Not even talking numbers. We're going to talk vocabulary, and we're going to talk about like exiting, and we'll give a little bit to people that know. Pretty much just going to talk about selling calls and puts. I don't even think we're going to get, if we blaze through it and it's going well, we'll talk spreads for those people that know what we're talking about. We'll talk to poor man's covered call, but just basic. Like I think a lot of people are scared of calls and puts because they just don't know what they are. And
I used to be that guy. And Brad,
me too.
Well, no, okay, but to back it up a little bit, I mean, Brad, you've been trading options for a bit now, and you're the one who kind of got me onto this game. You kind of showed me the numbers. You're like, dude, like, and it was easy for me to like trust you because, I mean, one, you're a buddy of mine, but two, I know your typical investing like strategy
philosophies. Yeah,
you're a basic index fund investor. I'm like, what is this guy who majority of his net worth is in index funds doing trading options? And I thought trading options was just like a gambler's game. I thought that's all it was. I thought it was a big gamble play.
Yeah.
And you're like, no, dude, there's this other strategy where you can do XYZ, which we'll talk about here in a little bit. And you're like, this is what I'm making. I'm making $1,000+ a month from doing these strategies. And I'm looking at it and you're explaining it to me. And I'm like, dude, my wheels start turning. And I'm like, holy crap, this is legit. Dude, I did
do a fair share of like flexing my premiums on you.
But you had to though. I mean, I had a clarity call with a subscriber of mine today who said he was watching both of our videos and he's making $3,000 a month now from the strategies we've talked about in our videos. Yes. Dude, it's a game changer. And this is the thing, like with these options plays and stuff, like I think options is one of those things where it's a strategy out there to make extra income if you do it the right way and the safe way, but no one really knows about it yet. Like there's obviously people who do it, but in the grand scheme of people out in the everyday life, in your everyday world who lives, like your next door neighbor, Bob, he ain't trading options. You know what I mean? And if he does, he's on a totally different spectrum. Like most people aren't doing this, but we're trying to kind of regularize. Is that even a word?
I don't think that's a word, but I think people know what you're trying to say.
Yeah, regular.
You're trying to make it more commonplace because
seriously, yeah.
We talked to a guy before making $30,000 plus on just the wheel, and he's been doing it for less than a year.
It's insane, man. It is absolutely insane.
So that's like the main thing. And we're not talking about like making all this money. Like for me, the money's great. I'm not planning on trying to do it for an income. It's part of my income. Go ahead.
Real quick, one of your stocks that you do that you can earn $100 to $300 in premium on, that's a door as a rental property every month, and you're doing monthlies on it.
Yes,
that's a door.
And we're going to talk about like the returns on investments and stuff. But yes, like everything I read, I have every Bigger Pockets book over here, and I have you. Like A single family residence, if you're making 250 a door, that's pretty good.
That's solid.
Right. So, and a down payment, and that's going to be on a house. Maybe you're going to need a $40,000 down payment.
Yep.
So if I have $40,000 and I can make more than 250 a month, I'm essentially, now I don't have all the other benefits, but from a money standpoint only, yeah, I'm making a couple doors of real estate every single month with, of course there's risks, but we're still doing this with a relatively controlled risk environment. And that's the thing. Like, to say you don't like options is to say you don't like sports. Every single sport, you hate it, but you're allowed to like this sport, but hate that sport.
Mm-hmm.
There's parts of options trading that I hate. Penny stock trading. I hate it. Short-term, out of the money call options. I hate them.
I do those every now and then.
I hate them. But like you were mentioning before, everybody, even a boring investor, the reason I got into this, frankly, is because I hated how intimidating it was. And as an academic and a lifelong like learner and an engineer, it pissed me off that what seemed like just a couple of vocabulary words and numbers was going to stump me. I have a degree in engineering. I teach physics.
Mm-hmm.
Like, there was no way that a couple numbers and a couple vocabulary words, like the Wolf of Wall Street, couldn't have been that smart.
Dude, I think options in general is scary for most people. I mean, literally, like, I've been in the stock market for 7+ years.
Right.
And I just started trading options, maybe a year ago, maybe a little over a year ago. And it was all because of you, to be honest. But I mean, dude, it's just like, once you understand, like, once you get to that, like, what is that called? That barrier of entry.
Yeah.
Once you cross that line, it's a very thin line.
Once you make your first put or your first call option
and you understand it, it's just like the doors open and the people start singing to you because you learn this whole other area to earn income.
Yeah. Not even just making the, like, I think when a option goes full circle, when you open it and then it either goes to expiration and you either get assigned or it goes worthless. But like, the ultimate is doing it or even buying to close, like knowing when you buy to close, you had full control.
So you're getting ahead of some people already. Let's dial it back a little bit. Yeah. So I think a lot of this podcast, Brad, is going to be me asking you questions because you're a little bit more experienced than me.
Mm-hmm.
If you're a new beginner, if you're out there, someone who's looking to make a little extra income, maybe you don't have a lot to kind of use on a stock or whatever. Yeah. What's kind of like that go-to strategy? What's the beginner place? If you're a beginner in the stock market and you've been doing it for a little bit and you're ready to transition to options, because I do believe you need to have a decent understanding of how stocks work before you move into options. Would you agree with me or no?
Yeah.
Okay. So have a little bit of have a decent understanding of how stocks works.
I mean, and an understanding, because you, at the end of the day, you are purchasing an underlying asset.
Absolutely. You need to understand it.
Yeah. You need to understand that. Yeah.
So once you get past that point, though, where are you at on a strategy? What does that strategy look like for someone who is just getting started and maybe looking to build a little bit of a small income with options trading?
I think to focus on one thing at a time. When I got in, I learned about the wheel strategy, and then I tried to go from the wheel and separate the call side and separate the put side and do all these things. To be honest, you can buy Leap's options as a beginner, but I wouldn't recommend it. Like, it's just, there's not enough. Leap's options are long-term anticipated securities. So that long-term, you're not going to learn a lot. Where with something like selling calls and selling puts, you can learn a lot with not a lot of financial risk. You can learn so much. And if you focus on just the call side or just the put side first, then start the wheel. And let me explain what the put side and what the call side really means, because I think those are the two pieces of vocabulary that people screw up. And I don't need to talk numbers. You might need to rewind this, hit that 15-second back a few times, but let's talk this. There are calls and puts, and everything I'm going to say is in terms of the buyer. So not buying and selling stocks. We're going to be buying and selling an options contract. Okay. Now, the buyer can buy puts or buy calls. When you buy a call, Okay. When you buy a call, that means you want to buy the right to pull away 100 shares from somebody at a strike price. And we'll talk what that means in a second, at a price that we want. And then the seller, you come along and says, I'll take that deal. When you buy puts, you're buying the opportunity to put 100 shares in somebody else's hand. So you're either calling shares away as the buyer, or you're putting shares in somebody else's hand as the buyer. Once you know that, you go over to the seller side, what we want. For the buyer to have all that control, I'm the one that's going to buy those shares. I'm this one that's going to put them in there. They got to pay a premium for that, right? They're having that control. They have to pay to buy something, just like in the real world. Us as the seller of that call and that put, and we'll get to that in a second after JJ has a question. But if you are the seller, they pay you. You're going to get paid to make that contract for them. What you got, JJ?
So if you're starting out in options and you're trying to figure all this out, you're listening to the podcast right now. Are you thinking that people should start out selling options first?
Yes.
Being a writer of the contract, or buying them first? Because I feel like when I first heard about options trading, buying is like the big go-to, because that's where the big money is. You want to buy options. You want to buy a call. You want to buy a put. Why would you consider selling versus buying first if you can YOLO on a meme stock that's going to go up 20%?
Right.
And
I think
go ahead. Yeah, you go.
The control that you hold, because like JJ said, the seller is also called the writer of the contract. So if you get to write the contract, you get to set the terms. Now the buyer of the option, they want those terms too. That's why they bought the contract from you. But they're doing it with a small pop. I'll say pop probably a few times, probability of profit. So as the buyer, yeah, you have a really, really high return, but your risk goes along with that as being very, very high. Not a financial risk, but the probability of profit. Maybe risk was the wrong word. As the buyer of the option, you need more things to happen out of your control. You need a stock to go up or down, and we don't know if it's going to do so. And if it goes the wrong way, you can be at a bigger loss. Where when we sell, all we're going to be losing is 100 shares or the amount of money to purchase 100 shares of a stock. Is that clear? I'll clear that up in a second, but does that answer what your question was?
Yes.
So now that we decide, like, okay, well, should I sell a call first? Because you said focus on one, Brad. Should I focus on selling calls, or should I focus on selling puts? It really goes, it's up to you, but let me talk about the type of person that might want to do each. Okay. When we get to more advanced, we'll start at the back and go to the front. Then when you get a little bit more advanced, you usually do one depending on if the stock is up or down that day. We tend to want to sell calls on green days and sell puts on red days. But that aside, let's talk about just barrier to entry here.
Real quick, Brad, can I interrupt you real quick?
Go.
Just before you get into this big details, I want to make a quick announcement that we did lower our Patreon status into the Discord to $1.
Yeah.
If you guys want to support the podcast, because, I mean, Brad, I don't really make much money from this. This is more of a passion project of ours, which we totally love.
Because we need better equipment.
We do need some better equipment. But if you guys want to support the podcast, it's $1. You can join in on the podcast, or join in on the Discord chat, excuse me. And we also do a pre-live, whatever the hell you want to call it, screening.
Live stream.
A pre-live stream before we do the actual one where we record the podcast. We do a separate link to all of our Discord members in there. Mm-hmm. It's $1 a month. That's all it is. It's a way to support your maybe not your favorite podcast, but
no, we're their favorites.
Okay, your favorite podcast. It's a way to support your podcast that you like listening to for $1 a month, and it really does help us out big time. But sorry, Brad, go ahead.
Now this episode's sponsored by our
There you go.
I think we have about 35 Patrons right now. So
yeah, let's go, baby.
Thank
you guys.
The type of person that's going to be selling these. So focus on one, and here's the type of investor or the position that you might be in. Say you have a stock that you really like, and you have the amount of money to purchase 100 shares. You don't really have any shares right now. Maybe you have like 5 shares or so, but you don't really have it a lot. Okay. To write this call, you need something called collateral, right? Your broker says, okay, well, if you're going to be getting 100 shares or giving away 100 shares, you need to either have those shares or you need to have the money to buy those shares. So say, for example, you have a $10 stock, a contract is 100 shares. So you're going to need $1,000 of collateral. If you have that $1,000, you might want to write a cash secure put first. If you have 100 shares of a stock, or maybe you have like 90, 95, go with the call. Now, I tend to go the call route first because while it takes some time to get to 100 shares for a lot of people, not many people could just go out and buy 100 shares. While you're building up 100 shares, you can start to learn and learn. And then when you get to 100 shares, you'll have a pretty good idea of what's going to happen. So when we do calls, we need 100 shares. When we sell puts, we need the amount of cash liquid in our buying power to purchase 100 shares.
Yeah, I mean, that's one thing that kind of confuses me about some of your strategies is you do sometimes come out and you'll do the buy the 100 shares first and you'll go straight to the covered calls, but I feel like lately you've been kind of switching more towards I've been seeing more cash secured puts coming from you, meaning selling put options saying I have the cash collateral there. I'm willing to buy 100 shares or however many there is available per contract, and that's what I'm going to set on that stock. Is there a reason why you're kind of doing that more? I mean, is there something that has kind of shifted you? Because I feel like before you would kind of build up to that 100 share portion to where now I'm seeing more of the cash secured put side from you. Is that because of the state of the market? Would you be doing this no matter what the market's doing? Would you be doing cash secured puts religiously? I mean, where are you kind of at now on that?
Yeah, you're absolutely correct. When I first started, I bought 100 shares of Wells Fargo, and then I used all of the premiums to build up 100 shares of AT&T, and T, and then I used all those premiums to build up, and I started all of them with the call side.
Mm-hmm.
And that was mostly because of the state of the market,
Okay.
because everything was up. Right now, things are kind of down, and as I was saying before, the premiums or the value of the option, premiums and value of the options are synonymous terms. The premiums are higher for puts on red days because we're back to thinking about the buyer. If you're the buyer of a call option, you want that thing to go to the moon. If you're the buyer of a put option, you want that thing to go to zero.
Yep.
And as they move in the buyer's direction, the value of that option goes up. Buyers want the value of the option to go down. Sellers want the value of the option to go to zero and be worthless. They want it to expire worthless and nothing happens. There's no exchange of collateral and you just repeat and keep all of the premium that buyer gave you to enter the contract with them. So there's really two reasons that I've been going towards the put. Number one, on the put side now, as things are going down, the markets are red. The value of put options are just, they're more money. And things being overpriced, I don't want to buy 100 shares of a $25 stock when I think their fair value is at 20. So the way options work, we didn't really get into the nitty gritty. I get to choose on the put side as a seller of a put, I get to choose how much I would buy those 100 shares for. If the current share price is $25 and I say this company's worth 20, well, what I could do is sell a put with a $20 strike price. The strike price just meaning the price that I would buy that option. So I get to set that and I get to set the expiration, the term of that contract to say, if it drops below $20 in the next 2 weeks, the buyer can exercise that option and I will buy 100 shares and my broker will have kept $2,000 from me to make that happen. And if it stays above $20 and it stays overvalued, in my opinion, it expires worthless. I keep the premium that the buyer gave me and I repeat. And I keep setting that CSP for $20. Now you see the problem with the call side. If I think the fair value is 20 and it's 25 now, and then next week it's 30, and I try and do a 20, I'm going to get less value because there's the value of the option varies when it gets to the distance of the strike price all the way up to the share price. So the further away it goes, now you're kind of like, oh man, now I have to move that fair valuation up a little bit if I want to collect a good premium.
So I want to say this too, real quick, and you may have mentioned it a little bit already, but I think one important note here with the kind of wheel strategy, selling puts, selling calls once you own the shares, is to make sure you're doing this with a stock that you're okay with owning if you're doing the cash secured put side, but also do this with a stock you're okay with selling on the covered call side. Because like Brad has been mentioning with the covered cash secured put, you're placing a strike price. You're placing a price at what you're willing to purchase 100 shares or however many contracts you write up.
Mm-hmm.
If you're looking at AMC, for example, like I've been doing AMC for a little bit. I'm okay with owning AMC at $35. And there's reasons why. You can look at that. You know, you can look at technicals, you can look at just the chart, whatever it may be. And looking at AMC, I'm saying, okay, if AMC drops to 32, I'm still going to have to purchase this at 35. I'm okay with that.
Right.
Same thing goes for a covered call. Let's say you own 100 shares of Apple. And let's say you own 100 shares of Apple at $145, and then you write up a covered call at 150 strike, saying if Apple reaches $150 at expiration date, you have to sell those 100 shares. You have to ask yourself this, are you okay selling 100 shares of Apple? Because if you're not, don't be writing up call options on Apple.
You will get assigned.
You will get assigned.
So the wheel strategy that you hear us talking about before I get to some of the questions that we got in the chat. So the wheel strategy is either starting with the cash secure put, meaning you pick a strike price, and then if it falls below that price, you get assigned. But then when you get assigned, you have 100 shares now. You just bought 100 shares. Then what you would do is you would sell a cash secure put, and you would just repeat that process. That's the wheel. When you have 100 shares, JJ mentioned the basis of $145 with Apple. As long as you pick a strike price that's greater than $145, you can't lose. And that's why YouTubers put the 100% success rate. And everyone's like, nothing in life is 100%. I'll tell you this. If I have $100, if I have a basis of $100, I bought 100 shares for $100, $1,000 in, and I set a strike price at $101, I can't lose. I made $100.
Yep.
And I got the premium from the buyer. Now, if it jumped to 110, yeah, I lost the potential to get all of that capital gain, but I still won.
You still came out ahead.
As long as your basis. So let's take the wheel, for example, starting the cash secure put side. I make a strike of $10. It gets assigned at $10. That means that my basis on those 100 shares is $10. I'm writing the call for anything over 10. Anything over 10.
Yep.
And then say it, so I make it 11. The next month, the next week, it jumps to 15. I get assigned. I have to sell at 11. I had to sell a $15 stock for 11. Big deal. Okay. Now it's at 11. I write a cash secure put for 11. My basis doesn't change. And I just keep collecting premium over and over and over again. And it doesn't matter if I get assigned or not. Granted, I'm going to pay taxes. You pay taxes on all income. The short-term capital gains. But it's back and forth. You just keep wheeling it back and forth. It's freaking glorious. The only way I stop a wheel is if something major happens, like it jumps 15% or it dives 15%. No big deal, because the basis always is going to stay the same as long as you end on a win. When I want to end a wheel strategy, I get assigned on the call because it's going to be above my basis, and and then I go to something else.
So let me ask you all the time. Let me ask you this then, Brad. If you're starting out the wheel strategy, or let's say you have 100 shares of a stock and you're wanting to write up a covered call, how close should a person be at the money? Meaning they're going to write up a covered call. Let's say, for example, Apple's trading at 150, and they're going to write up a covered call at the 151 strike. Is that something you would recommend, is staying close to at the money, or should you go, farther out and earn less premium? I mean, how does someone kind of structure those trades?
Okay, I could talk about that for sure. I do see something in the chat that I want to mention about the basis. It seems confusing figuring out the basis. Just the average price that you paid for 100 shares. If you take the total amount of money you invested to purchase 100 shares, divided by 100, that's your cost basis. As far as like the money line, you'll hear in the money, out of the money. If the buyer can exercise, it's in the money. So if you are selling a covered call and the strike is $100 and the share price is currently at 101, the buyer can exercise, that's in the money. The share price currently is called the money line, at the money. The closer to the money you are, with your strike price, the more premium you're going to collect. The further away from the share price you drift, the less premium you're going to collect because the option is less likely to do what the buyer wants it to do. Remember, there's a counterparty here. So as far as like where I go with the money, it really depends from option to option. And I don't want people to confuse like my covered call, my poor man's covered call. I know there's people in my Discord here, but for strictly a call, okay, I make sure that I tell everyone I look at this when I'm thinking about stocks to wheel, because people ask like, what's the right types of stocks to wheel? A stock I want to hold on to. Simple. The next is I look at what my basis is. Everything is based around my basis. Has nothing to do with expiration necessarily. It doesn't necessarily matter the strike price, the expiration price. The first thing I care about is the basis. If you don't know your basis going into selling a call or put, you have to. Okay. So I now know my basis. I know that I'm going to assign and I don't care about assignment. So I'm going to go as close to the money as I really want. Like as long as I'm above my basis. Now, sometimes you get caught where your basis is 150 and the stock's been trading at 140 forever.
Basis meaning average cost. Your average cost that you paid for those 100 shares.
Exactly. Yep. So sometimes if something happens where your basis is 150, you pay $150 per share for those 100 shares. Now it's trading at 140. You can't write a call above your basis and get a good premium. That sucks.
Right.
That's why you need to do this with a stock that you want to hold, because that's called bag holding. When it drops so low that you can't collect any premium going above your basis, now you can get risky. You can roll the dice. You can make that call under your basis. Go for it. That's up to you. But you could get a bag hold and you got to write that call all the way back up. You got to wait till share price goes up to your basis again.
But a cool part about this is that if you've been wheeling the stock for a while, or let's say you've been holding the stock for a while and you haven't got assigned for like 4 weeks in a row, you can account for that premium for your average cost. Yeah. So let's say you've earned, $50 a week from premium, from whatever covered call you're riding up. Mm-hmm. Well, do that for 4 weeks. That's $200. So look at your cost basis. And then you can subtract your cost basis from how much you're down. And let's say you've earned $200 in premium. You can add, or you can subtract the amount that you're down from the amount of premium you've earned. So maybe you're break even though you're really.
I am on one. I'll give you an example.
Go.
I bought 100 shares of Vuzi at $7. So that was $700. I've made well in excess of $700 on Vuzi. Well over. So those 100 shares paid for themselves. It's free money. And yeah, that happens. That's your adjusted cost basis. It's fantastic. It's awesome. I love it. And you can, now I didn't really want to get into the Greeks because that's like a money line thing too. But if you've been doing this, so this is a little bit more advanced. If you've been doing this, if you look at Delta is the percentage that the buyer is going to win, roughly. Not technically, roughly. It's an indicator, okay? So you see a delta of 0.2. That means the buyer has a 20% chance of this thing going in the money and expiring in their favor. So if it has a 20% chance, that means you have an 80% chance of you winning. All the numbers go for the buyer. Everything's in terms of the buyer. So if you are new to this, right, and you're not ready to get assigned just yet, you kind of want to feel this thing out, see what expiration feels like. When you click on the Greeks, look at Delta. Look at Delta and find a delta of 0.15. Find that delta. That means that you have an 85% chance of being successful. Just go by that. And then as you get a little bit more, you start to learn this, you get a feel. You'll just go a little closer to the money. Even if you do a 0.15 delta and you get $2 in premium, take the $2. Right? You want to step over $2 on the street, take it and learn. The best way to learn these options is going to be doing them and making mistakes, frankly. Sometimes you're going to make it too close to the money. Sometimes you're going to buy an option instead of sell an option. I talk about all the mistakes that people make. It's one of my most viewed videos because people make mistakes. And the comments in that video are all the same. Like, oh shit, I thought I was the only person that's ever made that mistake. No, you are not the only person that's ever bought a call when you meant to sell a call because you got excited.
I've done it.
I do it on a weekly basis, and I think as long as you start to learn that and you know all your possible ways to get out, all your outcomes, like expiration, like what's going to happen, what are the worst case scenarios? The worst case scenario when you buy a call, when you sell a call, is that you have to get rid of those 100 shares at the strike price that you chose. The worst case scenario in a cash secure put, the worst case is that you have to buy 100 shares at the price that you said you were okay buying 100 shares with. If you're nervous about getting assigned, you chose the wrong strike price.
Yep. Or the
The only
wrong
time
stock.
I've ever been,
Or the
the only
wrong
time
stock.
the only time I've ever been nervous is like when Wells Fargo dove below my basis and I had their basis at like $50. They were trading for like 22 and I was writing like $30 calls. And if they happen to go up by 20%, I was going to get called away and take a major, major loss on Wells Fargo. But people do it. I mean, I've gotten greedy and I always lose. That's why I don't trade spreads. And that's why I don't try these other things. I understand them, but I just don't have the ice in my blood.
What do they say that? Sheesh. No, I'll be the first one to say I'll try an out of money call option every now and then. I'll do it, and especially on a meme stock. But I'm also doing it on a very small amount of money. I'm talking maybe $100 here or there.
We don't play fantasy sports. We don't freaking gamble on the McGregor fight. We gamble on AMC sometimes.
Yeah, sometimes we're going to buy out of the money call options on AMC. But I think the real big thing here is really just try to understand and really learn writing first. Because a lot of people will come up to me and they'll ask like, "Oh, JJ, how are you making money from trading options?" I'm like, "Well," I said, "How do you trade options?" And a lot of people will say, "Oh, I'm buying calls on this, I'm buying puts on this, whatever." But so many people, I think, overlook the power of writing contracts, of writing covered calls, writing cash secured puts, doing the typical wheel strategy, keeping it simple, keeping it conservative, and just sticking at that. Now, guys, I will say this. If this episode was a little too much just from listening, Brad and I do have a course. We don't plug it ever. I don't remember the last time I've plugged it, but I'm going to say it here, because I do know there's a lot of jam-packed value in that course. You and I took a long time to put that thing together, but
it's 3 hours of content.
3+ hours of content, but it was a lot more than that of recording. But Brad
and it goes into the buy and sell side too.
It does buy and sell side. Brad and I got our digital whiteboard, so you guys are seeing real-time examples. It's a lot easier to follow. If you guys are interested in that, we'll have a link down in the show notes. If you guys want to purchase the course, you don't have to. We're not asking you to, but if you guys
want you to know it's there.
We want to know it's there. It's a jam-packed course for everything Delta related. You can go through, or not Deltas. You can go through the Greeks. Yeah. Brad does a really good job of explaining everything on that in the course. It's all laid out there for you. Yes,
the whole syllabus is there.
Yeah, check it out.
And I do. It's I go back and watch.
So do I, all the time.
Because I'm not sharp on everything all the time. And when we did that, we made sure we did the research and we were sharp. I go back and watch all the time. I do, because we're almost 40 minutes in. So I do want to talk to the people that maybe have been trying this.
Go ahead.
And give like maybe a little bit more the people that understand some more vocabulary. And like JJ, if you don't know, just bookmark this freaking episode and come back to it.
Yep.
Josh, I'm talking to you, bud. JJ's brother, Josh.
Yeah.
I know he's listening. Like, bookmark this freaking thing and come back and listen to it later.
Take notes.
Here's some things if you are doing the wheel. Like I said, once we log off, for the people in the chat, we can talk poor man's covered calls and spreads and all that stuff. But I just didn't want to put too much on. We could do follow-ups on all that stuff. So, Mike, oh man, cheers to you, bud.
Thanks, Mike. I already drank my beer, but cheers.
Thanks, buddy. I appreciate that. And tell the people in the chat, tell them your experience too. Because there's beginners, everyone. Oh man, Joe, thank you so much. He's taking the course and giving us some good feedback. So
thank you, Joe. So appreciate it. Big time.
One of the biggest questions, or one of the things that I've been hearing about, are what are some of those Greeks. I have a video on the Greeks too, guys. That's the other thing too. I'm not here to say get the course. I don't have those videos on YouTube. The beautiful thing about the course is that it's organized. It goes in the order that you should learn. Yeah, you don't have to go through it, whatever. The Greeks I really care about. I really only really look at delta, and I look at implied volatility when I'm buying options. I don't really look at implied volatility so much when I'm writing options, but I definitely do. And theta, I don't really look at the theta number. I just kind of know the general trend of theta, where theta stays pretty flat until about 30 to 45 days out, and then it really ramps up. And what theta is, it just eats away. It's time decay. It's pay to play for the buyer. Every day the buyer has to pay a certain amount of money to keep that option going. And as he gets closer to expiration or she gets closer to expiration, her likelihood of success is going to go down and down and down. That's theta. It's saying boop, boop, boop. And then it ramps up till we get to expiration, and theta eats it all away. And the value of that option is zero, which we say it expires worthless if it's out of the money. So when I write calls, I'm pretty much going to try and stay within that 30 to 45 day window, because remember, as the seller, we want the value of the option to go to zero. We want theta to help us. So if you sell weeklies, theta is going to be glorious. You'll see like 0.15, it's taking $15 every single day. Now, it doesn't happen on this like flick of a switch. It's not like the beginning of the day, it takes theta away. It's all the Greeks, they kind of move and ebb and flow throughout the whole day. But yeah, I'm kind of looking at deltas. Like I said, I look at it in the beginning more for risk tolerance, but now that I'm focused more on the basis, and I don't mind getting assigned in spreads and stuff, I'll look at delta a little bit more just to keep myself out of water. But that's pretty much that. And the IV, you look at the historical IV, it's kind of hard to find those charts for free though online.
IV, what's that, Brad?
Implied volatility, meaning how much the value of that option is going to change with a 1% change in its implied volatility, or how likely it is to jump all over the place and be wacky. And the buyer really likes that. And then, yeah, like theta, if I'm going to buy options, I'm going to make sure that I want theta. I want expiration to be way, way far out so theta can't hurt me. And if I sell options, I want expiration to be really, really close as I can really make it and tolerate it and be able to maintain it, because theta is really, really going to help me.
Shit, I thought IV meant ice in my veins. Sheesh.
Sheesh. Oh, no, somebody also calls, I hate when people call, well, IV is really intrinsic value. Mm-hmm. Implied volatility is really IMP vol.
Yeah.
To be honest, in like the professors out there of options are going to be like, IV is not implied volatility. It is intrinsic value. Whatever, dude. Thanks for coming out, professor. But people asked about brokerages. The Robinhood's still the easiest. We've been going to Fidelity.
Yes.
I don't like it. There's
really
things I don't like.
Dude, I feel like my my options get filled so much faster at a better price versus Robinhood, even though I'm paying that 65-cent fee.
I don't know. I think that's psychological, but whatever.
You think so?
Certain things, like we were saying, like I don't like that they don't show the current share price next to options. Like I want to know
what's
where
above
the share.
it.
I want to know where the share price is in relation to my strike.
The share price should be above. It shows it right above it in the options chain.
No, not in the option chain. After I make the option, while I'm monitoring it,
like on in your portfolio,
in our positions, yeah.
Oh yeah, it would be nice to show like for example, I don't own AMC in my portfolio, but I have an AMC cash secured put. Yeah, you're right. I have to go look and see what the current price.
I find myself
AMC
going back to Robinhood to be able to search things quickly.
You're right. I would agree with you on that.
As far as the technical side and making it happen, Robinhood's buy, sell. It's just so much easier. I'm gonna do a video on the Fidelity. I think you did a video on selling them on Fidelity too, but
yeah,
the brokerages. The types of stocks. If we are going to be selling calls and selling puts, we kind of want things that are moving in a steady, predictable direction. Calls, steady, predictable up and down, steady, predictable down, because applied volatility and huge spikes of 5% or 10% a week is just going to make your life miserable. So that's why dividend stocks tend to be major wheel stocks, or just these big blue chips, things that don't really move much. Or when we're in a market that's pretty steady, like we've been in a bull market, it's been kind of up. It's been great for calls. Right now, it's been a little bit red, so we switching over to selling some puts. It's tough with the puts because the puts also tie up collateral, but that's kind of another reason why I'm starting to like it, because you can hold cash, you can be liquid in cash, and you can have money set aside as collateral. But say, for example, you set a 6-month expiration and you get 10% return on your collateral from the premium. That's a 20% annualized return on investment. Like, who wouldn't take that? And you lock that in. And then if you needed that money to be liquid, you just buy to close the option and then you get that money liquid. So there's other reasons why I'm leaning towards that, but like the types of markets, we're going to be selling calls when it's green. We're going to be selling puts when it's red, but we always want that to be a little bit predictable and a little bit steady. And yeah, I just mentioned expiration lags. Those, it's really up to you because you are going to want to monitor them and look at them. So if it's happening where, like right now I'm on summer break, I don't really look at my options that much. So I'm selling monthlies right now.
Yep.
That's why I'm big Tattoo Chef, big on Voot. Like I'm just doing that because it's just easier. I just did a Leaps on Waste Management. That's a monthly as well. Things like that.
Yep.
But then when I'm back to work and I'm back in my office and I have my computer screen and my options chains up all day long, I'm gonna be selling weeklies. I'm gonna be on fire. It's gonna be awesome. Love it.
Dude, I'm about ready to turn this AC back on.
Do you?
I'm dying right now.
Do you? I think that's pretty like the basic gist of everything. The vocabularies that you need to know: strike price is the share, is the price that you want to sell or buy.
Yep.
Value or premium is how much you are going to collect, and it's yours right away.
When writing, yours selling to keep options.
When you write and when you sell or buy too close, you have to just pay that premium back. And that's really it. When you a call, somebody's going to call those away from you. When you put, people are going to put those shares in your pocket. Bears and Cheese. Is that Bears Nation?
I think it is. He says it's his favorite dad's.
We have to go get a beer. I think
I'll have to get a beer too.
He's a Long Island guy. All right, but
we'll stay on after the podcast.
I think if we missed anything, like I said, this was the best go at options video. I think because we didn't try and break down too much,
and it was live.
I know. Jeez. I think we just wanted to give people at least some things to go do some research on.
Yeah.
Like maybe we said something and you want to follow up or you want to look a video up or, like
watch our videos, watch Brad's videos, watch mine. There's information out there for you guys to learn. You don't have to buy the course.
And you don't have to rush in. Rebecca, if you're still here, like I know Rebecca did months of research before she did her first one. Months. And she has a YouTube channel and it's fantastic and could have been very easy for her to just like rush into options, start making options videos on her YouTube channel. She couldn't do it. Did you turn that on?
I've got to soon.
No, you got to wait a couple minutes, man. It's almost over. But like now you made me lose my train of thought with that. The haunting sounds of your AC.
It's so hot up here.
But yeah, no, Rebecca, if you're here, like let people know. Take your time. Don't rush right into the wheel. Start selling calls and puts. You'll be fine. It's going to be here. Rebecca, how long did you like learn or how long were you intimidated by selling calls and puts? And how long did you learn about it after that or during that intimidation process? And then finally just dive into it.
Well, that's where I like the strategy of like building up to 100 shares.
Yeah.
Because like as you're building up to 100 shares, you can be learning, you can be studying, you can seeing different strategies and what's working for people. That's where I like that coming in. Is like it takes you a bit to get to 100 shares, but once you get there, you're like, okay, I feel comfortable. Let's do this now. Let's write a covered call on these shares and see what happens.
Guys, leave us feedback in the Discord chat.
Yep.
Leave us feedback on the Facebook page. Like, if you want us to, if there's something that you really didn't get, the worst case scenario, I guarantee I have a video on it. I'll send you a video link or JJ has a video on it. One of us does, we'll get it to you. And then we just wanted to open the conversation about options. I am an index fund investor. 96% of my portfolio is index funds. And I love it. Everyone sees your diner. Let me just do the outro.
Okay, go ahead.
All right, JJ, so do you have anything to say before we get out of here?
Nope. Just ready to turn my AC on.
Don't say that. I don't want that to be in the recording.
Okay, go ahead. Say it again.
JJ, anything to say before we get out of here?
I mean, really, to be honest, man, I just wanted to kind of we preach like, we're average guys and stuff like that. I want something like options trading to be known as like just a regular topic. Like, yeah, it takes a little bit of barrier to entry. You need to understand a little bit what you're doing. But once you understand the basic foundations of writing a call option or writing a put option, it does wonders in what you can do with like a monthly income. Like we were talking about earlier, even before we hopped live on the YouTube channel and recorded the podcast, we were talking about how much money you can really make every single month. And Brad, there's months where you and I have touched over $1,000 in just premium alone from writing call and put options. That's more, think about how much money that would take in a down payment to earn that in rental income. You know what
It
I
is.
mean? It's crazy.
And it's fun when you get it, and when you
so
get in a
much
group,
fun.
and it's just fun. So, like I said, we just want to open that conversation. If you have any more questions, guys, please let us know. We want to tell you guys all the things we're doing, from budgeting all the way up to trading options. And till we see you guys in the next